2023 recession can make you rich. With inflation rising, the stock market falling, and gross domestic product in the red, pundits are debating whether the US has entered a recession. While the jury is still out on this question, you may be wondering what you can do now to better position your investments to weather a stormy economic climate. Here's what you need to know about investing during a recession. Is the US in a recession yet? The United States has not officially entered a recession. The National Bureau of Economic Research, NBER, an independent nonprofit organization responsible for determining the starting and ending points of US recessions, is standing by to issue a statement until enough data becomes available. NBER defines a recession as a significant decline in economic activity that encompasses the entire economy and lasts for more than a few months. Exceptions are extreme events, such as the sharp decline in economic activity from February 2020 that led to the intense, albeit short-lived, COVID-19 recession. A common indicator of a recession is 2 consecutive quarters of negative GDP. The United States has met this criteria in the first half of 2022. There was GDP growth of -1.6% in the first quarter and -0.6% in the second, but it's important to remember that this fact in itself does not mean the nation is in a recession. The drop in GDP was caused by supply chain disruption, said Brian Katz, Chief Investment Officer in the Colony Group. Inventory adjustments and net trade were responsible for most of the net growth. NBER's basic definition of a recession also calls for significant decline in economic activity, which according to Citi Global Wealth Advisor Michelle Griffith is not yet the case. But that story could change in 2023. We're watching closely to see if the Fed's rate hikes earlier this year begin to reduce demand too quickly, which could lead to a recession in 2023, Katz says. Rajesh Nakati, Chief Investment Officer of the Global Family Office in BNY Mellon Wealth Management, believes there is a greater likelihood that the US will enter a recession in 2023. What will the next recession look like? Even if a recession hits soon, Katz says it won't look like the Great Recession or the dot-com crash of the late 1990s. Big economic imbalances have exacerbated these 2 recessions, he says. The dot-com recession was caused by bad investments in the tech sector, and a major housing bubble spurred the Great Recession. If 2023 brings a recession, he thinks investors could expect it to have less of an impact on markets than previous recessions. How to take advantage of a recession. Investors must plan when structuring their portfolios, even if the next recession is mild. Cash is king during a recession. In economic downturns, cash is king, says Michelle Griffith, wealth advisor at Citi Global Wealth. As companies cut and increase job losses, it's better to be safe than sorry and bolster cash reserves in times of high employment. However, selling investments to raise money before a recession is risky. You could sell prematurely and be stuck in cash as the markets rise. A better strategy is to switch to investments well positioned to weather a recession. That's why keeping a certain portion of your portfolio in cash or highly liquid securities, such as a money market mutual fund, is always a good idea. Own defensive stocks in a recession. Consumer discretionary stocks tend to post strong gains while the economy is growing. They are called cyclical stocks, as this group gains and losses depend on the rise and fall of business cycles and consumer confidence. Defensive names in non-cyclical sectors such as utility and consumer staple stocks tend to be hedged against those ups and downs. During a recession, defensive stocks can help protect your portfolio. Companies that sell essential goods and services, such as food, electricity, and homes, are generally non-cyclical and less exposed to economic cycles, says Katz. Sales of consumer staples like food and beverages are quite recession resistant because no matter how bad the economy is, people still need to eat and use toilet paper. Demand for utilities also remains in a downturn, which helps utilities outperform other stock sectors during a downturn. The healthcare sector remains stable through the business cycle, NBER Analysis wrote in a 2021 report. If anything, when counties experience more severe economic downturns, employment in the healthcare sector appears to increase. Use dollar cost averaging. Dollar cost averaging is an investment strategy where you regularly buy a fixed amount of an investment regardless of the current price. Recessions are a great opportunity to use a dollar cost averaging approach because you will be buying stock as the price falls. You can dollar average the cost with new money or just set your dividends to automatically reinvest in the security, which would serve the same purpose. Buy quality assets during a recession. Investors should look for quality across all asset classes to protect a portfolio during a recession, says Katz. Low beta, high investment returns, and low leverage are the hallmarks of quality investing. He calls companies all-weather businesses that don't depend on economic growth to thrive and survive. Businesses with high recurring revenue, such as subscription-based sales models, are less susceptible to economic downturns. He says you should avoid companies with high debt loads, as they may trouble paying down debt if revenues and cash flow decline. They may also find it difficult to refinance the debt when it matures if conditions and credit standards tighten. Avoid growth stocks during a recession. Heading into a potential recession is not the time to own growth stocks. Growth stocks, especially non-profit companies tied to high growth prospects, do worse during recession, says Nakati. Instead, he considers more income-producing investments in dividend-paying stocks. Invest in dividend stocks. The best dividend stocks provide a cushion for your portfolio during recessions. Even if a company's stock price falls, it can still pay dividends. Dividends indicate strength and offer a method to measure the average cost of the dollar-cost market volatility, says Griffith. Obligations and unrelated activities. Bonds also tend to do well during recessions, but Kat says to hedge against rising delinquencies, stick with investment-grade bonds. Finally, true uncorrelated asset classes such as royalties, insurance stocks, and carbon credits do relatively well when traditional asset classes show weakness, she says. After every bear market comes a bull market. As Yahoo Finance notes, historically, the S&P 500 fell an average of 29% during a recession with an average decline of 24%, but once stocks bottom out, next year's average return is 40%, and in 2 years the market has grown by 58%. Reduce your expenses. This means you can track your income, cut unnecessary expenses, and operate lean while continuing to reinvest on a regular basis. You should also include a plan that outlines what you would do if your income fell by 20 to 50%, how you would make up that difference, and whether you can take preventative steps ahead to protect yourself from what happens. Protect your career. This, at the end of the day, will be your best hedge against whatever happens. After all, your worst case scenario financially isn't a down market, it's a down market at a time when you lose your job and can't afford to keep your investments long enough for them to recover. Now is the time to upgrade, learn new skills, duplicate everything, and use it to your advantage. Invest only for the long term. In general, it's best not to invest the money you might need in the next 5 years, and preferably more. The best course of action when it comes to investing is to do nothing different and carry on as usual. It shows that dollar cost averaging, or the practice of buying the market at regular intervals over the long term, is the most profitable investment strategy. So stay in the markets and keep buying. Diversify your investments. If you personally can't handle a 20% price drop without panicking, then you may be investing too aggressively. For example, if you're all about US tech stocks, consider adding international and large cap stocks to the mix, or potentially consider investing in real estate while rents tend to be more stable. The more legs your wallet has to hold up, the less likely it is to tip over if one or two of them fail. With that being said, it's time to end today's video. Press the like button and subscribe to our channel for more interesting stuff. Take care!